Welcome to another episode of Kiss My Assets.
The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate.
It was initially the 12% return, but it quickly turned into the people.
Welcome to the Kiss My Assets live podcast today, where we dive into all the important details about real estate investing. We love assets that are tangible, that you can drive by and see and touch. And we also love that these assets generate monthly cash flow and passive income. When passive income is greater than your monthly expenses, you have achieved true financial freedom. I'm Jamison Manwaring, CEO of Neighborhood Ventures. Neighborhood Ventures is a real estate crowdfunding platform that enables everyone to grow their wealth through multifamily real estate investing. And you can start with as little as $1,000. Joining me today is Bart Diehl, the Director of Marketing, and Heather Andrews in Investor Relations. So thanks for joining.
Happy to be here.
And thank you everyone for joining. This is our first live broadcast of our podcast. We do this every week and we're going to do it live a few times a month. So I'm excited about that.
Yeah, this is super exciting. Welcome to it, everybody.
So we are just going to dive into a few key points when it comes to investing in real estate and what's happening specifically with housing. This home hit the news this week, and this is a home that you can buy at Home Depot for $43,000.
Oh man,
this is the first thing I thought of is this is basically what used to be originally called a mobile home, then they changed to manufactured home, now modular home. But yeah, but you can buy this home for $43,000, and the word was from the news article that it was sold out immediately, and they couldn't keep it on the shelf anymore. So, you want to move in there, Bart? What do you think?
I personally wouldn't want to move into the tiny home. I think there's probably a little bit better bang for buck for what I'm going for. I mean, I know myself, and I know as a millennial, and what I learned during COVID is that when people, including myself, are forced to convert their homes into their gyms, their offices, their coffee shops, whatever it may be, there's a massive urge to obtain more space. So moving into a tiny home for, what is it? What did you say the price was?
Yeah, $43,000. So that doesn't include the land.
Yeah.
But it kind of goes to the point. A few weeks ago, we started talking about how renting versus buying across the United States was really in a peculiar position, in a peculiar state. So this chart shows, and this is recent data, that the cost to buy versus the cost to rent were always pretty close to each other. There were some ups and downs there from time to time. You could see in 2006 when the housing bubble happened, renting kind of stayed steady and housing prices went up. And what we're seeing now is a dramatic difference between cost to buy at about $2,700 a month versus a relatively similar size of home to rent at $1,850. And as investors in real estate, specifically housing, this is the sort of data that is really important to keep track of, and we look at all the time. If you take that across and look at specific metros, now this graph's probably a little hard to see, but these are all the specific metros across the U.S., and the ones in red at the top, starting at San Jose, San Francisco, Oakland, it is that is how much more it is to buy than to rent. And they're all, they're actually over 100%. And Phoenix, which is where we're at here, is about in the middle. And there's only 4 markets where it makes more sense to buy than to rent, where it's more cheap to buy. And this is also inverted. Typically, you're seeing more, you would see more areas where renting versus buying is more even cost. Now you look across the country, it makes way more sense to rent, all except 4 markets: Detroit, Philadelphia, Cleveland. It makes more sense to buy. And I want to, when we talked about this story on our podcast a few weeks ago,
Yeah.
we got a lot of feedback on our YouTube channel from particularly millennials who are and Gen Z who are dealing with this cost imbalance. So I think some of these comments are kind of funny. I'm 43 with no family. I bought a house in my 20s, and it was the greatest financial mistake I ever made. Now, my parents, they'd hear this and they'd think, this guy doesn't know what he's talking about. You got to buy a house, living the American dream. And there's definitely a lot of value to owning a home. You're going to build that equity up, but it's different now. If you haven't bought a home now, there's a different psychology. So this guy said, I ended up selling my house. I bought an RV, and I've been living in the RV ever since. At the end of the day, I own my RV outright, unlike the house. So, and he's 43 with no family. Hey, bachelor pad in the RV.
Yeah, that's kind of nice. I mean, I could see myself potentially doing that.
Not everyone has that ability.
Yeah.
You can read the middle one. I'll skip to the last one. These are just various comments from our YouTube channel from Gen Z folks. All this assumes that Gen Z and younger millennials will continue to be employable past 40 years of age. At some point, locking in the cost of rent becomes a necessity for survival. I've already met millennials that had to scramble to buy something because of the inflationary rent increases that had outstripped their income. And what he kind of points to is just the psychology around the younger generation now. If they don't own a home, they're just looking at renting in a completely different way. And it's pretty easy to see why. And I want to jump to a few things that we talk about a lot, which is supply and demand. So it's important as real estate investors to track the amount of supply in the market, both property that's for sale and how the values are selling, and the supply of inventory that's coming on, and then the demand, which if you're investing in apartments, it depends on the demand is how many people are in the renter pool, and is that demand going to increase? And I want to go back to Econ 101 here. So we know that this is the supply demand curve, and as demand meets supply, price finds that equilibrium there in the middle at the blue point. And that's what determines price. When there's a shift in demand, as we've been seeing with housing, where there isn't enough available supply, the demand curve or the supply curve shifts down the demand curve, and the price moves up. And you can see that here going from that red demand line to the purple demand line. And so the price, which is on the y-axis there, moves up. And we're going to talk a bit more about this, but what we're seeing today from all the data is that both for multifamily and single family homes, the supply of homes and the supply of single family homes and apartment buildings is lower than the current demand. And as we look out over a 5 to 10 year horizon, that trend looks like it will continue, especially in high growth areas. And that's why we are bullish and optimistic about housing and multifamily going forward in these high growth areas. So this just came out from Phoenix Business Journal. The Phoenix median home prices moved higher in May, and they're expected to continue to move up in June. And I think everyone expected that housing prices would start to come down when interest rates went from 2.5% to now 6.5% or 7%. They expected them to come down, they have not come down in many markets across the country. Some markets, they have a little bit. In areas like Phoenix, we just saw in May and now in June that's going to continue to move up. Let's look at the multifamily market. So we already talked about single family market in Phoenix, and this is also for the Phoenix market. So the first thing that stands out is, and this comes from ABI's quarterly report, Q1 quarterly report, that they put out about multifamily in the Phoenix market. And if you'd like a copy of the report, email us. We can send you a copy of the report. It's I got it right here. It's 10 pages, really dense report about what's happening with multifamily. Now, a lot of it's a little in the weeds, sophisticated, but I look at it and I'm happy to be able to talk about it today because it's hot off the presses, and we'll talk about it on here as it comes out. So the thing that stands out to me in this most recent report is the sales volume from year to year, from Q1 of 2022 to Q1 of 2023, and it's down 75%. So people are selling their apartments. Apartment owners are not selling those apartments right now. They have a position that we do at Neighborhood Ventures. Right now is not a great time to sell. We're happy to wait right now. And that's driven down volumes 75%.
Wow.
And that really stands out. Now, price per unit's also down 22%, but that's not as good of a metric to look at as, in my opinion, as price per square foot, because from any given quarter, sometimes there's bigger units sold versus smaller units sold. But the price per square foot's pretty consistent. It's saying, a year ago we were really at a peak when it came to apartment values, and now the price per square foot has come down 12%. And that's after a really strong run for a couple of years. And there's not as much transactions that occur with apartments when you look at these numbers. So you're looking at a smaller sample size. I think the other key thing to look at, two things I want to point out. The average rent was basically flat year on year. So a lot of people were hoping rent would come down. We saw big increases during COVID in 2021 and 2022. Rents have stayed strong, and we're going to talk a little bit about the outlook, but they've stayed strong. And then the last one that I'll point out, and then I want to open up some things to discussion. I just want to kind of talk about the macro view for a minute. But the units delivered were up 26%. So we delivered 3,400, almost 3,500 units in the quarter, and those are new apartment units in the Phoenix metro area in the quarter. So an annual run rate at 3,500 units per quarter is about 14,000 for a year. And this is important because during COVID, a lot of the new construction that was going to come on the market weren't able to get through the approval process. They weren't able to get constructed due to supply constraints and other things. So now we're seeing a lot of that supply finally come on the market. And I will say 3,500 is a lot less than people expected. And it's a lot less than what we need. If this is the construction pipeline in the Phoenix metro area, if we go all the way back to 2002 on an annual basis. And so you've seen since 2016, we've started to increase the number of units, 7,000, 8,000 units in 2021, up to 9,000 and almost 12,000 last year. And this year we're on a pace of 14,000. This is well below a lot of other growth markets like Dallas, like Houston. Those markets are doing 25,000 units a year, 30,000 units a year. So Phoenix still is behind when it comes to that growth. Based on different analysis, we need anywhere from 15 to 20,000 units, kind of depends on who you talk to, going forward, new units on the market just to house the people who are moving here. So even in a year like this year where we're seeing a lot of new units come on the market, it isn't saturating the supply. The supply still remains low. So that's a bit of the macro view, and it's important always to remember with real estate investing to have a long-term view. We can get caught up in these short-term news items that come out. What's the Fed doing? What's inflation doing? All those things are important. But in my opinion, it's more important to understand what's happening from a higher macro view, what's happening with wages, what's happening with supply demand, Econ 101. And so I want to kick it off with that. A little commercial break here for Neighborhood Ventures REIT, NV REIT. So this is our REIT that we launched earlier this year. The REIT is paying 5% annually, distributions on the 10th of the month. We just sent distributions a couple days ago. So we had all of our REIT investors were excited to get their distributions for the month of May that landed in their checking account June 10th. The REIT only holds cash flowing stabilized assets. So we're buying properties that have been renovated. They're either newly built, newly renovated. They're built to last for a 10 to 20 year period, and they're generating cash flow. That's why the REIT's already paying 5% distributions. The REIT only invests in multifamily assets. So that's important right now because we see some headlines out there about commercial real estate and some of the struggles with commercial real estate. And if you go below the headline and look at the actual detail, in commercial real estate, the area that's struggling are offices. It isn't multifamily, definitely is not industrial. Some cases it's retail, but multifamily remains really strong. And the REIT only invests in multifamily. All the properties are in high growth Sunbelt and Mountain West areas, and you can begin investing with $1,000, and then you can do $100 increments afterward with auto invest feature. So the REIT is something we're really excited about. Like I said, a little commercial break plug for the REIT. Heather, I want to ask you, because you talk to a lot of REIT investors, what are some of the reasons why so many people are investing in the REIT right now?
Well, I think this covers exactly that. It's already cash flowing. There's an immediate return, but there's also long-term growth. So you kind of get the benefit of both. But I did want to say about the auto invest, that's been one of the most popular options that are new investors that are starting with just that 1,000 and want to continue to build it slowly at their pace. This has been really popular and really exciting.
I love that. Yeah, Bart, what do you think?
I think another big thing for the REIT is that it's available to non-accredited investors. So, I mean, so much of real estate investing is held for the, pretty wealthy, the extremely wealthy, and the REIT gives access to those people who normally wouldn't be able to invest in real estate.
Yeah, so $1,000 minimum, and then after that, you can set up an auto invest at $100, which is pretty amazing.
Yeah.
We also have big investors in the REIT.
Yeah.
So we have some folks who have put a lot of money there that are accredited and multi-accredited. We love it that we welcome everybody. And Heather made a good point. It's paying 5% cash distributions, but you also, as an investor, get 80% of the upside as those assets go up in value. So if you think about, I could buy an apartment building myself and do all the work, or I can invest with us, don't have to do any of the work, and I'll get 80% of the upside. 20% goes to us because we're doing the work. It's a pretty compelling way to put some money to work for you because of the upside. And you have to understand what we're talking about today is that housing is in demand. It's going to continue to be in demand. We're in an interesting time right now, and it remains to be in demand. And as things level out, as inflation, we saw good numbers today. Inflation came down. And I think we'll continue to see that. And then as interest rates go out of the elevated area that they're in now and they come back to a normal area, then housing comes right back and when it comes to resell. But we don't have to sell right now. And that's the important thing is these properties are cash flowing, and we can just continue to see the cash flow come in while we watch the market. So I want to shift over to this. There's a piece that was in the Business Insider that talks about how the housing market is on ice, or they call it the housing market's ice age. And this has a bit to do, especially with the younger generation as they're looking to buy a home. But if you look at this National Association of Realtors Home Affordability Index, you can see, and this is part from this article, you can see that in July of 2020, the supply of homes available just nosedived. And it's like if you were able to get in and buy something before July and buy a home, you were okay. And and then afterwards, it just continued to nosedive. And it talks about what this means for potential buyers, not only now but in the future. And Bart, what are some of the other insights from this article that stood out to you as a millennial? You're an older millennial.
Yeah.
You're on the upper end of that curve, but you're in that cohort.
So my biggest, my takeaway, and it's, to dumb it down to people who really don't understand what's going on. For me, the comparison is home buying as a millennial has been like trying to time buying Dogecoin or Bitcoin price fluctions. It's high, it's low.
Good comparison, because both of those sound like a nightmare.
But if you bought at the right time, you've probably accrued, a significant amount of wealth. But, with respect to the housing market, pre-July 2020, you could have afforded 30% more house than you could today with $300,000. You had an all-time record low mortgage rate. And if you purchase a home, you've been stacking thousands upon thousands of dollars in home equity for the past 3 years. So that's if you had bought a home pre-July 2020. Post-July 2020, you're likely sitting on the sidelines like myself and other people, a lot of millennials. We have a staff member raising her hand right now. You're still waiting on the sidelines to be able to purchase a home, waiting for mortgage rates to lower, the median home price to lower, and have spent the past 3 years just throwing 30% of your income at rent. So those are some of my biggest takeaways from this article.
It's almost like if you didn't get in, your mindset has shifted. You're probably a little cynical about the owning a home. And we've seen that in surveys. We've talked about on the podcast before. Recent survey, 70% of Gen Z said, I would prefer to rent the rest of my life. I don't care. Renting has more benefits. Because you've seen, it's like you've seen that your friends who did buy, they rode the wave and they got that equity. And now if you're buying at that entry point.
Shout out to Heather here, because every time we have this discussion, she talks about this being her identity. This is, she prides herself in buying the home at the right time.
No, this was the one good thing I did. I got it right at that right time. And I think this article brought up a good point that if you're in this 30-year mortgage at this little itty-bitty mortgage rate, you're not going to sell ever. And so this has long-lasting impacts. It's a generational thing now, where the pressure now is on multifamily to be providing apartment buildings and that are what Gen Z and millennial and are looking for. And so it can still feel like a home. It's something they still want, because that home ownership is less likely for quite a while.
Well, and you hit right on the next point in the article, and the next graph I have here, the number of active homes for sale. And there's always this wave. The summer months, as you can see from this graph, kind of mid-year, we see more inventory come out. And then at the end of the year, beginning of the year, it's slower. And we see those numbers come way down since that July 2020. So these are people actively listing their homes, and those numbers have stayed so low. So that supply has stayed so low. And the reason is that you just hit on is, if you're sitting on a 2.5% interest rate, why would you sell your house today and pay 6.5%?
I think a cool thing the article talks about is like 4 contributors to why this ice age is happening. So why we have this have and have not marketplace. So first, the pandemic, it happened. And then in order to stimulate the economy, the Fed lowered the borrowing rates. So this gave everyone, this allowed people more access to mortgages, these low rate mortgages. And then demand for houses surged because people were working from home. Consequently, they wanted more space. And then, home buyers, to Heather's point, got locked into these historically low borrowing rates. And then 5, the ice age happens, which is what we're discussing right now.
We're in the ice age today. Yeah, it's pretty amazing. These consequences from big actions at the government level, the Fed, the stimulus. Now that's all getting processed and digested here in the few years after the pandemic, and this one really stands out. Now, the other important thing that we look at and that we get a gauge on is what some of the big firms and smart minds are saying about where things are going. And Zillow, where everyone knows Zillow, you can't really count on their price value for your home necessarily for an appraised value, but it's always fun to look at. But they do have a pretty great team of economists. And prior to this last week, they were expecting homes to move up 3.9% in value in 2023. So there'd be an increase of just under 4%. Because of what's happening right now, because of this ice age, they are not seeing the people they expected in the summer months list their home. So, we saw that curve that's down, and then summer, more supply, it's going like this. And so they're now saying we expect 5% appreciation on homes. So you own a home and you got in, even if you bought it at the end of last year, national average 5% is what Zillow is saying they expect. So that's pretty significant. I mean, typically homes are going up 2-3% on average nationally. We're still seeing elevated numbers there. Fannie Mae, which is a government-sponsored entity, affordability concerns combined with a lack of inventory due to homeowners' reluctance to sell off their low fixed-rate mortgages are helping buoy prices through the rest of the year. The ongoing lack of supply of homes for sale continues to drive demand for new construction, despite higher mortgage rates. So, as we get through this and we see what's the landscape is looking like, you have to as Wayne Gretzky used to say, you have to see where the puck is going. And as an investor, that's really important. We remain very optimistic, very bullish on multifamily in key markets. We find the right properties. And as investors, if you find that right property in that right area, you're going, I think you're in the right spot. And these trends really point to that. Wanted to open it up for any questions.
I have a quick live question. Did you have that Wayne Gretzky quote queued up in your head, or is that just something you fired off right there?
I pull that one out pretty often. Right.
My question later is going to be, who is Wayne Gretzky?
Come on.
Well, we don't have time to answer that today. We probably our biggest question, I'm going to refer to Heather on this. So what is the rate of return? What's your expected return on the REIT if I invest $10,000 today? And I'm going to put you on the spot, Heather. How would you answer that one? Because I know that's the most common one.
So right now we know it's paying 5% annually. So if you're doing $10,000, that's going to be paid out monthly.
Well, you're actually doing you could even just leave it at that. So you get 5% on the 10,000. I don't. You can calculate it if you want, but that's so you get the 5%. We can keep it in percentages to keep it simple.
$500 a year.
But okay, yep.
But which is nice, and that's what when I talk to new investors, that's nice to get, but it really is the long-term growth that is more valuable, that I think is more interesting, and so if you're able to, with that distribution, to reinvest it or kind of keep it working for you and be focused on that long-term value, I think that's going to be more beneficial, more exciting for you.
Yeah, and we have, as we mentioned, 80% of the appreciation over time. And, in this year, what Zillow just said was that property values are expected to go up 5%.
Mm-hmm.
So if you take 80% of that, that's about 3.5%, 4% off the top of my head. So you get that appreciation side, and then you still get the cash flow as well. What are the other common questions that we're getting, Heather, about the REIT?
One of the big questions is, because we're getting a lot of new investors from across the country, is they're wanting to know more about us. Where our Arizona investors are able to come meet us and we'll drive by the buildings, is we're finding ways to communicate with people outside of Arizona so they get to know us, they know what's important to us, and know that their money is safe and we're treating it with respect and thoughtfulness. I think one thing I'd like to talk to them about is the properties that the REIT holds. We look to our projects. So these are projects we have been with since day one, where we purchased them, we renovated. We have wonderful construction crew. We have a great property management company that we've really put the work in to make this a great stabilized cash flowing property, and now really want to keep this long term to keep benefiting our investors. And so I always encourage new investors to really look at our site and look at our properties page, our renovation videos. There's a lot of resources there where you really can get to know us and see how we approach projects. And so you have a lot of confidence in that property that the REIT is holding.
I think that's a great point. You should never invest in something that you don't understand. And I had a friend who invested in Bitcoin. He had saved up his money. He was an entrepreneur, saved up about $20,000. And he said, I'm invested in Bitcoin. And my first question is, do you understand Bitcoin? Because I don't. And I know a lot about finance. I don't understand it. I don't see the value in it. And he says, well, I don't either, but my friends are doing it.
Oh, no.
And he invested in it. And then one of the exchanges that went bankrupt was the company he invested in. And that wasn't necessarily Bitcoin's fault, but he lost his total investment. I love being able to drive by a property and know that I have my investment in that property. It's cash flowing. And it's easy to understand. And that's why we want to spend the time today, talk about the things we're thinking about as we look at the future. And we appreciate everyone for joining us today, and look forward to having you come again. And thanks, Bart and Heather, for joining us.
Thank you.
And we'll see y'all soon.
Bye, guys.
Thank you.